So obviously you've signed up some of the traditional large conservative banking institutions in Europe already. What does that tell us about the state of this technology of stable coins? How do you convince banks like those to join?
That's a good question, Christer. Well, I think it tells us, the wait and see era is over. I think it tells us that the banks are starting to see blockchain and blockchain rails as an important piece of infrastructure in terms of how the future of finance will be shaped. So, I mean, in terms of Qivalis and how we fit into that, we're having founded Qivalis in Netherlands last October. We weren't aiming to build just another crypto asset. We're aiming to build a general means of on-chain money that people can trust. Blockchains represent an internet of value driven by elements like tokenization of not only, financial instruments, but also all kinds of real-world assets. And this internet of value needs a settlement layer, or a connection to the real world or the fiat world, however you see it. And we are building just that infrastructure piece, that interface between the blockchain layer, which offers efficiency on all kinds of measures, and the traditional market infrastructure. So, fundamentally, we're an answer to the question of how can we bring the efficiency of the blockchain to the core of the European economy without compromising on safety. The rationale, and I think this is why the banks are interested. We're building it with sort of institutional integrity. This is an open consortium. It's not just the 12 banks that we already have. We're in talks with a number of more banks to join the consortium, and that consortium will grow over time. It is and will be a fully regulated EMI, issuing an EMT under MiCA. So we'll have the regulations will all be in place. In due course, supervised by the Dutch National Bank. And we'll ensure that every euro token is backed one-to-one by cash deposits and high-quality liquid assets as required by MiCA. And finally, neutrality is the kind of the third pillar here, right? So we aim to build a piece of neutral infrastructure. We aren't here to compete with the banks or the fintechs. We're here to provide the digital plumbing that will allow them to innovate in this space and allow them to create use cases that will pass on that efficiency to their own customers. I guess by building Qivalis, what we see the banks acknowledging is, all these infrastructure pieces are going to come together. Things like programmable money is inevitable. So to compete in a Web3 and IoT driven global economy, we need a 24/7 native on-chain euro. The regulation is a moat, not a barrier. MiCA provides legal certainty that allows the banks to build use cases on chain with an amount of certainty around their regulatory requirements. And finally, settlement speed is a new interest rate. Waiting days for cross-border settlement or for the settlement of money market funds is no longer a viable option for corporate clients, and they're increasingly interested in taking advantage of that. So, imagine a German OEM needs to pay a set of suppliers. The second part hits the warehouse. Qivalis can turn, the stablecoin that we're building would turn a multi-day reconciliation nightmare into a single smart contract trigger, for example. Or a large corporate treasurer, moving money in and out of money market funds using a tokenized money market fund on the one hand, issued by, for example, one of the banks that we're working with. Then with a stablecoin like ours on the settlement layer, you have the possibility of 24/7 liquidity. In T plus 10 minute settlement rather than T plus 1 or T plus 2 days. So that's, significant benefits to the kind of the client base of our shareholders and anyone else, looking to really take advantage of that space. So finally, I guess, sorry, just to kind of round it all off, what it tells us also is that European banks are taking the lead in building their own infrastructure. So, true sovereignty, and this is kind of the core of it, true sovereignty in 2026 and beyond is not just about borders, it's about data and payments. And so if European companies have to rely on non-European payment rails or non-EU payment rails and foreign-dominated stablecoins to conduct instant cross-border business, we have a vulnerability in Europe, right? And the European Union was built on the idea of integration, and that integration must be digital as well. So we aim to provide an institutional-grade, sort of made-in-Europe solution that keeps the digital financial destiny in our own hands.
You touched on quite a few interesting things there. So let me follow up and double click on some of those.
Sure.
So the MiCA framework still pretty new, and I'm thinking a lot about acquirers these days. And so if I'm an acquirer trying to understand what MiCA means for my business, what advice would you like to give them in terms of what they should be doing right now? Perhaps if they want to be ready to collaborate or work with you as you think about your launch.
Sure. Far be it for me to give anyone advice on how to operate their business, but I guess we're seeing the operational landscape shifting. I think based on the current activity amongst a number of even tier one merchant acquirers, the focus has kind of moved from a theoretical view of blockchain and that kind of stablecoin space to more concrete structural changes. So you have a number of of these acquirers are now getting crypto custody licensed under MiCA. Which is a process in itself and one that you shouldn't be taken lightly, but is crucial in order to work with that with the new digital economy. You've got merchant acquirers looking to settle in stablecoins already, making B2B payments using stablecoins for faster global treasury moves. And so I guess to kind of become a bit more concrete, the move to CASP licensing is kind of becoming increasingly important. So this is something that we're seeing more and more in the market. Like I said, it's a regulatory necessity to kind of legally facilitate custody and transfer of stablecoins or other on-chain assets. Modernizing your infrastructure for real-time settlement. On the one hand, we have SEPA Instant and these payment flows in Europe, but external to Europe, not necessarily. But you need to make sure that you've got your core infrastructure is operating in real time rather than batch processing, as maybe once was the case, because these transfers will enable 24/7 liquidity and 24/7 movements. And looking a little bit further into the future, you've got agentic AI and stablecoin experimentation, which I think may come faster than we think. It seems like everything these days with AI is coming faster than we think, and I think we need to start to be moving towards experimenting with agentic AI to manage, programmable stablecoin flows or enabling AI agents to independently authorize micropayments, execute complex treasury rebalancing without human intervention, possibly, or just, for example, like an autonomous car. At some point, it's going to pay for its own tolls, right? It's going to pay for recharge or fuel. You need to build the systems that enable all of that.
So one other thing you talked about was interoperability. So obviously one concern when anyone thinks of a platform or network is that it becomes perhaps a walled garden only for the member banks or the ones that are connected. How do you think about connecting or making sure that this is something that works with everyone? And how should acquirers think about that interoperability? Should they partner with multiple vendors, multiple platforms, or is there a smarter way to think about that?
This is, it's a critical kind of distinction, I think, for us. We're definitely not building a walled garden, right? Qivalis is not a private ledger for the 12 banks or for even just a larger consortium. It is, I guess, a regulated piece of public infrastructure, if you like. That's how we think about it. It is going to be an open standard that will be used, hopefully, by not just the shareholding banks, but fintechs throughout Europe. Our counterparties will be CASPs and licensed intermediaries, but then beyond them, the token will be used by anyone who wants to use it. And that includes not only the acquirers and the kind of financial institutions, but also all the way out into hopefully into the the DeFi space and the crypto natives who are using these stablecoins every day already, and who actually are already suffering from this sort of dollarization problem, which I think is one of the core topics that we're talking about in Europe, and why this on-chain euro is an interesting thing. But to come back to your question of walled garden, we think of acquirers as connectors, right? So for Qivalis and this stablecoin we're building to be successful, it needs to be used at the point of sale. It needs to be used in supply chain finance, on decentralized marketplaces, and so we want it to be available and usable for everyone.
So you also talked about cross-border and how you are enabling that. How should acquirers think about their role in the ecosystem? What role do you kind of mentioned it, but perhaps you can elaborate a little bit more. What role do you think they're standing at risk of losing, perhaps as a result of stablecoin and the changes that are coming?
As I said, the ecosystem we're trying to build is it's inclusive, but obviously, like any major technological change that involves increased efficiency, it will be disruptive as well. So on the one hand, as I was saying, I think we see them as kind of orchestrators, orchestrators of liquidity. I think they gain a role in, specifically acquirers gain a role in value-added distribution. So, acquirers will become one of the primary bridges between Qivalis as an infrastructure layer and the merchant's storefront. So they will kind of evolve into liquidity orchestrators, helping merchants manage off-ramps between the on-chain euro and legacy fiat accounts. So they're kind of the glue that holds together, the piece that we're building with the market, if you like. I think they will probably lose the role of kind of, interchange rent seeker in that, if you want to call it that, in that their margins will be compressed, right? Because the increased efficiency will mean for certain types of certain frictions will be removed, right? Which kind of may end the era of being able to charge high fees for simply moving data slowly through opaque, correspondent banking networks. But it's I think it's a natural evolution, and it's one that the clients, and especially on the corporate level, will kind of require and will demand more and more, right? So in the end, while there will be sort of margin compression in the long run for sure, in the short run, actually, you may actually see the margins grow because you have much more efficient processes, and you can probably keep your fees for a period before they start to get compressed.
John Oliver, super interesting insight. Thank you very much for your time. I appreciate that.
My pleasure. Thanks a lot for inviting me along.